Hello and welcome to Portfolio Matters Weekly Markets Checklist, week 171. But before we get into it, I will read the disclaimer. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware we'll be discussing securities that we own or have financial interest in. Please do your own research, consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Full disclaimer can be found at the end. So once again, thank you to Stuart Owen for joining us in the absence of Richard. Recording today on Tuesday, the 17th of September. Now, I'm away again this weekend, actually, but next week we'll be recording on a Friday and hoping to get back to regular Friday episodes. Okay, news this week. Well, tomorrow on Wednesday is the FOMC meeting. Jerome Powell is expected to cut interest rates. The market now is betting on a 50 basis point cut. The odds are 2/3, 50, 27%, 25 basis points. The ECB met last week and they cut by 25 basis points. Harris and Trump held their first and we expect only presidential debate, which I watched and was great telly, frankly. And Harris is widely thought to have won that debate and her odds on winning the election have improved. Equities had a very good week after Nvidia's CEO declared that demand for chips was great and sparking a strong tech and equity rally. The S&P ended last week up 4%, Nasdaq up 6%. Commodities generally had a very strong week, helped by a weak dollar. Some charts relating to the news. Well, the headline was that the ECB had cut their interest rates by 25 basis points. That's the deposit rate, which they'd cut to 3.5%. However, their main refinancing rate, which is the rate applied to short-term liquidity lent by the ECB to commercial banks, frankly, the most important rate they have, that was cut by 60 basis points from 4.25 to 3.65%. So the cut in Eurozone interest rates is larger than the headline figure. If you look at the real rates in the Eurozone, and the yellow line here is the deposit rate, which is 3.5%. You'll see that real rates in the Eurozone are the most positive they have been since 2007. And given that the Eurozone economy is kind of stagnant, as soon as inflation comes under control, you expect interest rates to come down further. In the US, we had decent inflation numbers last Friday, and they have caused the market to price in more interest rate cuts. The market is now pricing in a lot of cuts in the next couple of years.
Keith, just on that,
yeah.
What's your view? Obviously, you've taken quite a substantial position being long fixed income. But
Yeah.
do you have like a mental model where you think inflation is going to come down to sort of the pre-pandemic levels?
I do. I think inflation is going to come down. And I think that if you stand back and look at where we are, everywhere is running huge deficits. The US is running a deficit of best part of 6%, I believe, 5.7%. Inflation's coming down. Everywhere actually you're struggling to create inflation despite big deficits. And just like in the UK, I think deficits have to come down, fiscal consolidation, and that will be weak for economic growth and actually will tend to bring inflation down further. I think inflation, we're still suffering from the after effects of the inflation surge. So you're seeing in the UK, we've got high public sector wages. That's a lag effect. And as soon as those lag effects go, I don't think anything's structurally changed since pre-pandemic. So I'm expecting weak economic growth, particularly in UK and Europe, and interest rates come back down. Now, the market seems to be expecting quite sharp interest rate cuts over the next few years. The danger is they're too aggressive currently without a further slowdown in the US. The key danger for me and the markets is that the cutting interest rates too hard causes a resurgence in the economy and a resurgence in with inflation. Your thoughts, Stuart?
Well, I'm a bit more confused about this because sort of medium term, I'm thinking, green energy transition, increase in defence spending, etc., are sort of big structural supports to demand, and I could see them being, a cause of higher inflation, and on top of which, I'm not sure which way the demographics fall. Now, is an aging population deflationary because old people don't want inflation, they vote, they don't spend so much, or is it inflationary because it gives younger people wage negotiation power? But it does seem to me that there are possible tailwinds that would increase inflation.
Yeah, no, I agree with that. And it's a debate we've had, and we've done sections on that in previous weeklies on demographics. And it's not clear whether the drop in demand from an aging population offsets the fall in the labor force. But in the case of green energy, green energy is fundamentally less productive than using fossil fuels. And therefore, in order to make these long-term low productivity projects viable, you need a low discount rate. So I just don't see how green energy projects are really viable without low interest rates.
So your argument is sort of rates have to be low because the consequence of them being high is too painful.
Yeah.
But maybe we just have to suffer. If there is the commodity demand for the green energy transition, and in a sense, there's the unproductive defense spending. I mean, it might have to be done, but it's not, in a sense, economically productive in terms of like any particular return on investment. They strike me as pushes towards fundamental demand.
That's on one side, but the fiscal deficit is going to come down because they're going to raise taxes. So, that's the bottom line is very high deficits are unsustainable. At this point, inflation is still coming down despite enormous deficits, and the deficit is going to shrink as the UK cuts spending and increases taxation. So I think that inflation has to come down. So markets are now pricing in a 2/3 chance of a rate cut of 50 basis points tomorrow from the Fed. Let's wait and see what happens. Markets have got very excited about the prospect. Now, the sharp drop in US interest rates implied by the US 2-year compared to current Fed funds is unprecedented outside a recession, basically. Either the market is pricing in a severe US economic slowdown, or it expects inflation to come down very quickly and sustainably. If that doesn't occur, then treasuries may well have got ahead of themselves. The S&P had a great week, up an astonishing 26% year on year. The Mag 7 were up every day last week, recovering from recent lows, but they have failed to recover recent highs. The presidential debate ended with prediction markets decisively moving towards betting that Harris will win the presidency. Now, this is the US federal deficit. And further to our discussion, it is absolutely unsustainable. Whoever wins the election needs to start doing something about it. Harris has a plan to raise corporate taxes to 28%. And on to this week's economic data. Quick summary: UK economy is resilient but not growing. The EU economy remains weak and showing little signs of improvement. The US economy remains strong, but the labour market is showing definite signs of weakness. China, all the Chinese data this week was very weak. And further to last week's discussion, it seems that the Chinese economy is suffering from structural weakness, and that may be deteriorating further. Stuart, UK.
Right, so GDP month on month came in flat against expectations of a small rise of 0.2%. Obviously, these numbers are going to be a bit volatile, not too bad year to date. So reframing that as year on year, July is up 1.2%, so a bit worse than expectations. Industrial production month on month, pretty awful. Expectations were for a slight rise by 0.3%, but actually it came in at minus 0.8%. Right, so when we compare actual industrial production with the manufacturing PMI, well, it does rather imply we shouldn't bother looking at the manufacturing PMIs, doesn't it?
Yeah, you see, I just don't understand this. So so late last year, industrial production growing, but the PMI's negative, below 50. And since then, PMIs have moved up strongly. But, last month, so in July, sorry, UK industrial production, negative. I don't get it. There just seems very little relationship between the two, frankly.
Is there a difference between industrial production and manufacturing?
There is.
Like they should be identical, but they're not necessarily.
There is, but they're very highly correlated. Frankly, in order to streamline the podcast, I have just reported industrial rather than manufacturing, but they're pretty identical, frankly.
Okay. Yeah. So industrial production year on year is now minus 1.2%. Not very happy.
Yeah, much worse than expectations.
Construction output year on year minus 1.6%. I think we've spoken about this before, that the construction PMIs were pretty positive, but the reality appears to be flatlining to down. Construction PMI, well, right, yeah, was very healthy, 55.3, but output actually fell by 0.4% month on month. So perhaps it's the reality numbers we should be looking at, not the PMIs. Trade balance, oh, this is awful, isn't it?
Yeah.
Minus 7.5 billion in July. Obviously, people were expecting it to be negative. It's almost always negative, but that was much worse than expected. The RICS house price balance, I was actually perked up quite a bit. Expectations were to remain around the same level of minus about 14. It actually came in at +1. So that the Great British House mania remains in place.
Yeah, the slightest hint of cuts in interest rates and people return to the housing market.
Yeah. UK Citigroup Economic Surprise Index still positive. Came in at 22.6. Not bad. That's quite nice. Indeed, job postings, that, however, looks rather ugly, having taken a step change down. It's not bounced at all. So in summary, for the UK, GDP growth was 0 in July, unchanged from the 0 in June. So the UK had a pretty good first half of the year, but appears to have plateaued. Despite positive PMIs, both construction and the industrial sectors did actually contract in July. And as Keith just said, the hint of falling interest rates seems to have led to renewed interest in the housing market. So the UK is sort of resilient but stagnant. It's not in recession, but it's not growing much. The Labour government has got a very difficult task, given all the demands on it. Growth and productivity is the only real answer, but that requires long-term and structural changes.
Thanks, Stuart. On to the EU. So we had industrial production numbers for July, and they were poor, but in line with expectations, down 0.3% year on year, down 2.2%, actually better than expectations, but still not very good. Balance of trade, though, remains decently, healthily positive, beating expectations, pretty much unchanged on June. Wage growth, though, too high. Q2, 4.5% year on year, well above expectations, though down a bit from Q1. But step back, over the last year and a half, really not much moderation in EU wage growth. If we look at the labour cost index, that's worse. So 4.7% year on year in Q2, and that implies actually negative productivity growth. Not great. Economic surprise index remains firmly negative. The GDP nowcast also remains firmly negative for Q3. Job postings continue to fall in Germany and in France. Now, we have talked about this before, but France is a problem. So the latest do-nothing scenario, reminder, France does not yet have a functioning government, I believe, because they have appointed Michel Barnier as Prime Minister, but he's going to struggle to get anything done given the Socialists have a majority in Parliament. France is running a budget deficit far worse than the 3% fiscal rule from the EU, and the French economy is not doing very well. If they were to start cutting it, you can imagine the French economy will do even worse. What's going to happen? Will the EU actually start to impose some fiscal discipline on France, which would be politically incredibly difficult? And I thought this was an absolutely amazing chart and reminder that in a fixed currency regime, adjustments to competitiveness have to come through real prices. In this case, the price of wages. So since the GFC, real wages in Greece have fallen over 25%.
I think the shocking thing about that is not the initial step change down, it's the fact that, even over the past couple of years, there's no bounce back. It's miserable.
Yeah, absolutely. It's amazing that the Greek people have put themselves through this in order to remain within the Eurozone. So EU summary, very little data this week. The Eurozone industry remains in contraction, but the EU trade balance is very healthy. The Eurozone economy is weak despite unsustainable fiscal expenditure in some of its key members, particularly France and Italy. What will happen if the EU starts to actually impose its own rules? Actually, what happens if it doesn't impose its fiscal rules, Stuart?
Well, I wonder whether you get a breakup, but not in the way that you might initially expect. I mean, maybe you get sort of frustration in countries like Germany that have tried to obey the rules, and you get people leaving in frustration rather than people being booted out. I say people, obviously I mean countries. It's one of it's sort of this dilemma which never seems to quite come to the boil.
Well, last week we talked about Mario Draghi's prescription for returning the Eurozone to health, and it involved common bonds, etc. And Germany have basically said that would essentially mean them subsidizing the rest of Europe, and they're not going to do it. And when you look at the debt to GDP numbers in the Eurozone, Germany is very low. Everyone else is high and rising. So they don't want to participate in any kind of common scheme because they think that the rest of the Eurozone is not behaving itself.
Well, I do wonder whether something like Draghi's diagnosis is right, but the prescription is almost like another top-down solution, and perhaps the answer is sort of 1,000 small changes bottom up to do with deregulation.
On to the US, Stuart.
US CPI month on month came in at 0.2, just bang on expectations. Very nice number. which makes it year on year 2.5%. Again, the Fed very happy, hence the discussion about how much rates are going to be cut tomorrow. The core CPI month on month up by 0.3, bit higher than expectations, but still within the range.
Yeah, not great actually.
Year on year, flat, 3.2% in August, the same as July. And effectively all of the inflation in August was in services, which we've spoken about a lot, that goods inflation has become deflation. It's all about services, and a lot of that issue is housing. Oh, well, I say it's housing. Apparently, it's also transportation, airfares. So the Bloomberg provide a breakdown here. So not just housing.
But when you look at housing and transportation, it really is just those two. There's nothing else.
Yeah.
And the vast majority
of housing, yeah.
Yeah.
So where is inflation, where isn't it? Auto insurance is a big contributor, though the rate of growth of auto insurance does appear to have peaked. Okay, so if we start torturing the data and we look at CPI shelter, which is this important component of the rising core CPI, or at least the slow fall in CPI, we can torture the data. We can look at month over month percentage change annualized. So if you just look at the last single month and annualize that rate of growth up in shelter costs, then it's about 6.5%.
Yeah.
If you take a 3-month average, it's not too bad. Well, it's not great, but it's okay at perhaps 4.5%. So it's not coming off the boil in the way that we had been expecting.
Well, it's odd, Stuart. I mean, it's an odd, noisy piece of data that is, at odds with, for example, the rents, which did not show a big spike.
Yes, I mean, this is the issue, isn't it? That the shelter component is calculated looking at all tenancies in effect over the past 12 months. Whereas if you look at Apartment List and Zillow, they'll look at just new tenancies.
Yes.
And their rate of growth at rents is much lower. Having said that, there's a difference between those two private sector data sources, with Apartment List being substantially less, showing much less inflation than Zillow. Now, another way of looking at this is not just annual changes, but growth in nominal rental costs since the beginning of, for instance, 2021. And if you look on that basis, the green line is CPI rent, and Zillow is higher, but a lot of that was growth in rents in 21 and 22. An Apartment List show a rather different picture where, yes, a lot of growth in 21 and 22, but then flat since then. So it's slightly more messy picture than I realized.
Yeah, but the point is that CPI rent, so previously it understated inflation, and over the last year it's kind of overstated inflation, but now it is broadly in line with the change in rents. So there shouldn't be that much of a systematic bias going forwards.
So that official measure of CPI shelter inflation does track private rents, but with a lag. The monthly data is noisy, though. So this lag does appear to be, what is the estimate in this chart is about 17 months. So there's short-term volatility, but the trend is pretty clear that bulge in rental inflation has gone through the system and should be reflected over the next few months in the official data. If you calculated US CPI using the Zillow rent index rather than the official calculation, then CPI would have peaked at over 12% in 2022, but would now be pretty much below 2%, just 1.85% according to this calculation. So if we try to look at a sort of super core inflation, so core CPI, i.e. excluding food and energy, and then we also exclude shelter because of the methodological problems, then inflation was only 1.7% year on year in August, hence why the Fed should be happy and why it will be cutting rates. We just don't know how deeply and for how long. So food inflation has collapsed just 0.9% year on year. But my goodness, that was a painful peak, 13.5%. And to some extent, that's going to be what people remember. And I think there's going to be a folk memory for a while before that sort of gets flushed out. So food prices have tumbled. Largest drop on record in August, apparently, with a pretty substantial, what's that, about a 4% fall month on month. Goodness.
Yeah.
And that's, oh goodness, that is calculated by looking at 1 trillion visits to retail sites. The internet can be fabulous. And 100 million product codes. That's, I guess, like the grocery version of Indeed, isn't it?
Yeah, no, it's great, amazing what you can do. And so this is real time data.
Fantastic. Yeah. If we try to look at lots of different inflation measures to get a general sense, we got CPI, core CPI, median CPI, trimmed CPI, PPI, etc. Well, they're all showing that the inflation bulge has gone through the snake. It's just a question of what level it's going to stabilize at. But all of those measures are lower than the short-term interest rate. Looking at monthly data and the share of components displaying high inflation, well, it's very few. It's back to even lower than pre-pandemic levels. So the diffusion of inflation, as it were, has also dissipated. US inflation swaps are pricing in inflation falling below the 2% target in coming months. So that's an encouraging from the financial markets.
It is, but what happens if inflation, fails to move below the 2% target? Seems that the markets are actually being quite aggressive in their assumptions of the path for inflation.
Goods deflation for short is at its highest in 20 years. So yes, I suppose you have to ask how long that can continue. So the downdraft from goods inflation may dissipate, and that might provide a small uplift to inflation.
Yes, that is my fear. That does not look sustainable to me. And when the goods deflation dissipates, then unless you have services inflation coming down further, which, to be fair, that's shelter and that should come down, then inflation would tend to rise.
US PPI came in at 0.2% in August, a little higher than expectations, though the July number was revised down from 0.1 to 0, so no great signs of problems in PPI world. Putting that in the year-on-year context, 1.7%, perfectly satisfactory.
Yep.
Michigan consumer sentiment perked up a bit. We all know this is very political. If you start dividing this number into independents, Republicans, and Democrats, you get very different pictures, but not too bad. Consumer expectations also recovering quite nicely, came in at 73, better than expectations. But current conditions, my goodness, that's a real difference, isn't it? It
is.
Being very depressed. So people are miserable at the moment, but think things are going to get a bit better.
Yeah, and that was the same pattern last month.
The New York Fed Empire State Manufacturing Index looking very perky. Expectations were for it to remain in negative territory, but it bounced very strongly to 11.5%. Oh, sorry, 11.5 on this reading. You've got a lot of data there in the chart. Keith, is there a key message in there?
No, if you're interested, pause and have a read. But I thought this was really interesting. So we've kind of stopped reporting the kind of individual Fed's manufacturing indices. But this was data out yesterday, and it's a very significant surprise upwards. So I've included it. But obviously the data is very noisy. You'll see that we have had extremely strong prints before, which are just part of the monthly variation. You would say the trend has been generally upwards, but this is likely a suspiciously strong data point, I'd say.
And is this only specific to that state, or it's supposed to be nationwide?
No, it's only specific to the New York State.
Yeah. The NFIB Business Optimism Index has fallen off again. So this is smaller companies, isn't it? Independent, smaller businesses not looking very healthy. And talking of which, small businesses are not doing very well on the earnings front. So this is a measure of the net balance of growth, is it?
No, so this is the net balance of businesses reporting better or worse earnings, I believe.
Right.
And it's strongly negative.
Initial jobless claims, well, I think we've sort of covered this quite well last week, didn't we? A similar pattern of initial jobless claims not particularly picking up. I'm slightly more elevated than it was a year ago, but no great uptrend. And initial claims versus the non-COVID average. Well, actually, this is a bit elevated, isn't it?
Yeah. No, that was actually a leap relative to the average.
Continuing jobless claims, pretty much the same as last week, though we did cover last week the issue that there could be people falling off the window of eligibility. And if you try to adjust by looking at the non-COVID average, then this does actually look somewhat more elevated. Turning to the regional Fed GDP estimates, 2.3% this week coming in from the US Dallas Fed. Atlanta Fed 2.5%. New York Fed 2.6%. St. Louis Fed 1.6%. And the US Citigroup Economic Surprise Index, not so happy, -27. So people have been optimistic and are having to reduce their expectations. US Indeed jobs postings sort of flatlining a bit.
Yeah.
It's not continuing its fall, is it?
No, that looks like job postings are stabilizing.
US Trueflation just 1.1%, so that'll be encouraging to the Fed. This is not seasonally adjusted, but that is a very pronounced downtrend, isn't it?
It is, yeah.
US bankruptcy cases continue to rise, and that does appear to be now higher than the sort of 2017, 18, 19 level. So we're seeing this. Oh, right, we've got Chapter 7 bankruptcy. I'm more familiar with hearing about Chapter 11, but Chapter 7, whatever that is, has been rising a lot. So US in summary, inflation is continuing to fall towards target. The headline numbers remain a bit elevated due to auto insurance and the shelter issue. But I mean, if you're being realistic, then the shelter numbers have to come down. All the private sector numbers suggest that the official numbers will trend to a lower level. Goods prices are showing deflation. That's great for the moment, but there's a risk that even if they fall, even if they increase to 0% inflation, that will actually provide a bit of an uplift to overall inflation because currently it's in deflation. Consumers remain pessimistic, but a bit less so than last month. Small businesses clearly not feeling very optimistic. So the US, it remains pretty resilient, certainly, the cleanest dirty shirt in the world, but definitely some signs of weakness in the labor market. And with that clear downtrend in inflation, the Fed will be cutting tomorrow. The question is 25 and 50 basis points.
Thanks, Stuart. On to China. So a lot of data this week. Industrial production missed expectations, slowed in August from July to 4.5% year on year. Retail sales missed expectations, down in August from July, and that's quite a poor number. Fixed asset investment missed expectations, down on July in August. House prices fell further into deflation, down 5.3% year on year in August, below expectations, down from July. Foreign direct investment, this is a shocking number, worse than expectations, down 31.5% in the year to August. The unemployment rate ticked up. Do we believe that number? Not sure. New loans came in lower than expectations, but a bit better than July. But in the grand scheme of things, that's quite a poor number. Outstanding loan growth. Look at the trend. Really slowing, down from July and below expectations. The money supply grew 6.3% year on year. That's M2. But then I saw this on Twitter. M1 fell 7.3% year on year in August, the largest drop ever. M1 is shrinking. So, reminder, M0 is notes and coins in circulation, and that is not shrinking, but M1 is shrinking. So that's notes and coins in circulation plus demand deposits and other liquid deposits. M2 continues to grow. So what that implies is that demand deposits are shrinking, and that, to me, implies that you are having negative loan growth. So people are paying off their loans, and that is shrinking bank balances. Stuart, any thoughts?
All the different monetary measures often confuse me, so I wondered whether there was another interpretation where if M2, which is quite decent, showing no break in trend, could that indicate people were not making demand deposits and they were buying longer term deposits, like sort of 2-3 year bonds, and therefore annoying the Bank of China that doesn't want people to be buying bonds.
Yeah, but the thing is, Stuart, that doesn't destroy money. It just moves it around.
But isn't that what we're seeing, that M2 is fine, whereas M1 isn't?
Well, M2, so M1 includes demand deposits, but if I use some of my demand deposit to buy a T-bill off you, you still end up with money, which you have to deposit in a bank.
Right. Yes, it's that circulation effect, isn't it?
Yeah, that's right. So I don't quite understand why M2 is holding up so well when M1 is shrinking. If somebody can explain this, please get in touch. And when you look at long-term government bond yields, that is a pretty frightening picture, actually. The bond market is betting on Chinese economic stagnation and lost decades and a balance sheet recession very much in the Japanese mold. Summary, all the Chinese data missed expectations. The Chinese economy looks structurally weak. Okay, on to one chart. And talking about China, I thought this was an absolutely shocking chart. This is companies created in China year by year, and it's absolutely collapsed.
That really has. That is extraordinary, isn't it? I'm basically down to zero.
Yeah, I found this chart just shocking. Something's going on with the Chinese economy. That, there's a
No
loss
one's
of
taking any
confidence.
risk. No one's
Yeah.
to do anything. That is phenomenal.
Yep. So, it looks to me like in order to make the Chinese economy recover, the Communist Party is going to have to do something, revert to huge stimulus of some kind.
But do you think it's really to do with issues like stimulus? Or this is a big change in people's animal spirits and their fear of what success is permitted. It's more of a political decision almost, rather than anything to do with subsidies or interest rates.
Well, the thing is, Stuart, previously fiscal stimulus has worked.
Mm.
So, then one thing they're not going to do is loosen political controls. So they're only going to do what they can do within their system. So right now they're not doing anything. But if they continue in the current vein of just cutting interest rates mildly, then it looks to me like the Chinese economy is going nowhere.
And I'll tell you what, this scares me. In a situation like this, a short, sharp war to stem the tide of discontent. Oh, what a nightmare that would be.
Yes, that would be super bad.
Mm.
And on to SimonW's technical analysis. So, equity markets have had a very strong week, and Simon has updated his analysis. So this is the S&P 500, and you'll see the S&P has returned to its previous peak, but it has not gone above that. Simon thinks that the S&P is still in a topping formation and it's likely to hit resistance at the red line, and it's unclear where it's going from here. It could be in a new channel, or it could fall back towards the rising yellow line. It needs a strong catalyst to propel it higher. And even then, you would need it to break decisively higher than the red line in order to confirm that it's broken out of its current pattern. Simon's basically saying, wait and see, not sure where it's going to go, but the previous strong upward channel has definitely been broken. In the case of the Nasdaq, the new down channel remains intact. The current rally has failed to approach the previous all-time high, and that is fundamentally bearish. It implies the previous channel has definitely been broken, and current downwards channel may still be intact. Reminder, Simon's played this last year very well.
I shall be the voice of doom, given that I suspect I know what the what this is going to say. So this is the OBR's long-term forecasts for the UK budget position. So in summary, the UK faces severe medium to long-term fiscal challenges because of an aging population with a falling birth rate and the baby boom cohorts moving through to retirement, which puts downward pressure on revenues and upward pressure on spending. Secondly, climate change will lead to increased fiscal costs, and three, rising geopolitical tensions, which will apparently lead to an increase in defence spending to 2.5% of GDP. So not a good picture. This chart is just extraordinary, and in fact so extraordinary you think, well, it can't happen. This is a chart showing overall revenue as a percent of GDP flatlining over the medium and long term, compared to forecasts of government spending, which just, I mean, that's just a steady rise. I don't know what the exponent is, but it's a sort of exponential rise on a gentle basis. But the gap between the two just becomes, you know, obscene and impossible. So projections for public sector net debt in the yellow line, which I think is the 2022 forecast, debt was supposed to be coming down before beginning to rise from the 2040s onwards. That now happened. We now have a baseline which is much higher, debt to GDP, still actually remaining below 100% for the next sort of 10, 15 years, but then rising very painfully. And if you start to assume that those compoundings will be worsened by the occasional shock, then debt to GDP, yes, public sector net debt to GDP is even worse. But I've got to say, Keith, that the fact that this doesn't start getting painful for another 10 years or so leads me to be very nervous about anything prophylactic being done ahead of time. Limiting the rise in global temperatures to less than 2% rather than 3% would alleviate about 10 percentage points of upward pressure on the debt to GDP ratio. So these are costs which will come from coastal flooding, from river and surface flooding, and from extreme heat events. So if heating, warming can be held below 2%, then the costs of this are proportionately more bearable.
Yeah, but I don't think that's really in our control, frankly.
No, quite. Another thing which in a sense isn't in our control, or without very big immigration, is the population structure, is demographics. I think we sort of all know this, don't we, that the percent of the UK population age, the younger people are going to become a smaller and smaller part of the population. 2024, about 49% is the younger working age, and that's going to dip to 45%. More importantly, people age over 65 is going to go from 18% to 27%. So Yeah, we're all going to follow Japan.
I'm
And
amazed actually that only 2% of the population currently is over 85. It's going to rise to 6%.
yes, and I think healthcare costs go exponential, don't they?
Yeah.
Yeah, because there's a lot of the cost is in the last few years of life. So the aging population, totally unsurprisingly, will mean a steady rise in healthcare expenditure. Bottom right, health spending as a share of GDP. I mean, look at this. I'm going from, what's that, 7 or 8%, doubling basically over the next 50 years.
Well, that just can't happen.
Yeah. So the fundamental challenge is that the elderly are, of course, big recipients of government spending by the NHS, but they contribute relatively little to revenues as they stop working. So another big contributor to the rising deficit will be interest payments on rising debt. So of course, this is very subject to your assumptions about what interest rate you're paying, but the principle has got to be true. More debt, more interest, which produces a larger deficit, a larger debt, which causes more interest payments. So
Yes.
it just goes ballistic. Many countries, of course, facing this issue, notably the States.
Well, what they've done in Japan is, of course, incredibly strong financial repression and
Yes.
to get interest rates seriously negative in real terms. And, let's see what happens going forward. But you know that the government will force the books to balance.
But the Japan example is interesting, isn't it? In a sense, they've got a first mover advantage. The cost of them doing that has been borne by a weakened currency. But if most of the developed world has got the same problem at the same time, we can't all depreciate against each other.
Yeah, but we can all depreciate relative to fixed assets like gold.
True. So possible solutions, well, the best solution is higher productivity. If we could raise the productivity rate by 1% from the current projection of 1.5%, which, by the way, we've not achieved for quite a while, if we can raise that to 2.5%, then it keeps debt to GDP constant at around 100% of GDP. So that is, the golden solution, isn't it? Was it Krugman who said productivity may not be everything, but it's almost everything? And
Yeah.
this is a good example of it.
Yeah, the thing is, Stuart, I'm skeptical because the thing is, we know productivity has been in steady decline over the last 100 years. And raising it by 1%, I mean, politicians would love to do that because it gets them out of the hole, but nobody knows how to do it. And book recommendation: The Rise and Fall of American Growth, he says, looking at his bookshelf, by Robert C. Gordon.
Ah,
It's an
yes.
enormous book, but it's brilliant. And it takes you through why productivity growth has fallen over the last 100 years. Basically, if you go back 100 years, you had absolutely transformative technologies. So you had the transition from horse and cart to the automobile, which allowed cities to expand. You had elevators, which allowed buildings to expand upwards. You had washing machines, dishwashers, which allowed women to go to work. All of those made huge differences to the amount of time people could spend working and their productivity relative to the amount of time they had to spend at home or commuting. Now, there are no big transformative technologies. EVs, that's the big thing. That's, doesn't actually increase your productivity at all. It just changes the fuel consumption and climate change. Like wind power, again, actually less productive than drilling for oil. I don't see where you are going to get higher productivity from unless you get a huge AI revolution. And AI will only really affect the information technology sector, information processing. You're not going to get dishwashers or hospital orderlies being much affected by AI, I wouldn't have thought.
Yes, I share your view. The low-hanging fruit, the easy wins came early in the various sort of industrial and information revolutions. I mean, hopefully we're being curmudgeons and there's something out there, but there's
Yeah.
very little evidence of it so far. So other solutions, tackle climate change, right? Okay. Global cooperation needed there, sort of, as you said before, outside our control. Second, increase public health to reduce healthcare spending, in particular, tackle the rise of mental health conditions that affect people of all ages. Well, it's a huge problem, isn't it? How to reform health provision in the UK. When I wish Wes Streeting well, but my God, that's turning around a super tanker, isn't it? It's going to be very
Yeah.
difficult and take a long time. Fingers crossed, but going to be difficult to bake that into your central assumption. Other solutions, number 3, reduce welfare entitlements. Yes, well, we'll see
Yeah.
what screaming goes on to avoid that. So the bottom line, in the medium term, UK public finances are on an awful path. Either growth has to rise or expenditure commitments have to fall. So less spending on healthcare due to improved public health or reduced commitments, or less spending on pension entitlements to increase the participation of the elderly in the workforce. Big changes are necessary. You perhaps need a benign dictator to enact these things. A government elected every 5 years, I think, unfortunately, is going to find it very difficult to get structural changes through.
Yeah. It's a lot of it comes down to expectations. In the UK, we expect you to be able to retire at 67 and live off the pension from the state. You know, one of the things that I took away from my recent visit to Japan is all the old people work. You know, you go to the local park, there's all the people brushing the leaves or clearing the streets are elderly. And so in Japan, it seems that the expectation is that you'll keep on working. And, you know, that is a possible solution, but deeply unpopular.
Yeah.
Okay, thank you, Stuart. On to Donald Trump's tariff proposals. So Donald Trump is behind in the polls, but this election really matters because the two candidates, Harris and Trump, have very different economic agendas. And Donald Trump has previously equated a US trade deficit with other countries, with them taking advantage of America. And if he's elected, he's proposing to raise tariffs on imports. He's proposing a 60% import tariff on goods from China and 10% import tariff on goods from the rest of the world. Now, Barclays estimates that the net effect of his 2018 tariffs was to a surcharge of 2% on imports. They estimate that these tariffs, if enacted, would raise it to 17% and would have severe economic consequences. This is the history of US tariffs, and you see that if Donald Trump's proposals come into effect, they would raise import tariffs to the highest they've been since the Great Depression. And spoiler alert, that wasn't good for the world economy or the US economy. Now, the US is a relatively closed economy, so the amount of trade it does with the rest of the world compared to its overall economy is quite small, and therefore is likely to suffer less than more open economies in a trade war. But Barclays expects its trading partners would retaliate by raising tariffs on American goods, but not by raising tariffs on goods traded between themselves. And so they estimate Trump's tariffs would reduce GDP in the Eurozone by about 0.7%, in the US by 1.4%, and in China by 2%. Notice everybody loses. It would also raise inflation because the cost of imported goods would rise. And as the US imports a lot of components from China, that would raise the cost of pretty much all its manufactured goods. And that would mean the Fed would need to raise interest rates and bond yields would rise. The dollar would strengthen. That would be bad for the world economy and emerging markets in particular. And entities with US dollar debts would find it difficult to earn the US dollars to repay those debts because the US is cutting its trade deficit with the rest of the world. Equity prices would be likely to fall. Higher inflation, higher interest rates, retaliatory tariffs, greater economic uncertainty, all of those are bad for the stock market. The bottom line is, if Donald Trump follows through with his campaign rhetoric, then his economic policy would have severe economic consequences for global markets and the global economy. Now, while we're talking about tariffs, the big lesson from history is the effect of the Smoot-Hawley tariffs of 1930. Now, in 1930, the US was at the beginning of the Great Depression, and the rhetoric then as now was that cheap foreign goods were unfair to the US and exacerbating the Great Depression. So Senators Smoot and Hawley aimed to protect primarily American farmers from cheap foreign imports. But as soon as they proposed this bill, lobbyists from every other industry joined in, and the bill became widened to include most sectors of the US. Now, the background is import tariffs were already high at around 40% following the 1922 Fordney-McCumber Act, and the Smoot-Hawley tariffs raised those by a further 20%, so above 50%. And it came into law on the 17th of June 1930, despite over 1,000 economists writing to Hoover to say this would be a very bad idea. As soon as it was enacted, other countries responded by raising their own tariffs on US goods. For example, Canada, which consumed 20% of US imports, raised tariffs on US goods, but cut them on goods from the British Empire. So the net effect was to reduce American trade. The net result was a huge decline in world trade. So this is the effect of the Smoot-Hawley tariffs. You'd see tariffs had been cut throughout the early years of the 20th century, contributing to the economic boom of the 1920s. Smoot-Hawley took them right back up and above where they'd been for most of the 19th century. This is the performance of the US economy during the Great Depression. Not great. So in 1930, it was already doing poorly. Smoot-Hawley contributed to much bigger drops in the next couple of years. Now, this is one of the most famous charts in economics, and this shows the effect of the Smoot-Hawley laws on international trade. And so it shows that international trade spiraled down over the next 3 years from 5.3 billion to 1.8 billion. International trade collapsed by 2/3. Now, if you don't like the spider chart, this is it in a linear chart. You'll see a huge drop over the next few years. And that affected the stock market. Now, Smoot-Hawley thought that industries that were most affected by the tariffs would see their profits rise, and that would be good for them on the stock market. Instead, the opposite happened. The shares in those sectors most affected by the tariffs actually fell, presumably because investors dislike the economic uncertainty and the threat of retaliation by trading partners. So, from its highs in August 1929 during the Great Depression, the Dow Jones fell by over 80%, and the Smoot-Hawley tariffs exacerbated the Great Depression. It was a disaster for investors. So, bottom line, tariffs raise the cost of trade and thereby reduce trade. Tariff rises provoke retaliation, leading to a reduction in overall trade volumes and a reduction in economic activity. Trade is good for consumers. Consumers get more choice and better prices. Tariffs are bad for the stock market. So, Donald Trump says a lot of things he doesn't do. Let's hope this is one of them if he gets in. I have prepared a section on the oil market. I'm going to spin that out as a short separate podcast in order to try and get the current podcast in at around an hour 30. Stuart.
Right, inflation watch. So I think the main number here is the US numbers coming in 2.5% for CPI in August, core CPI 3.2%. So this is obviously the trigger for the FOMC to cut interest rates tomorrow. We will see how far they go. Output prices suggest that US inflation will continue to moderate. The PPI leads the US CPI, and that's an encouraging sign. Freight rates are falling again. This, I suppose, is an encouraging sign for inflation, but it's not an encouraging sign for demand, for activity. But across many different international trade routes, prices are falling.
Yeah, I was very surprised by this, given the Houthis continue to attack anything that moves in the Red Sea.
So the main fear of a return of inflation is that rapid interest rate cuts cause a resurgence in demand. And there is some tentative evidence of that from US starter home sales, which is the light orange line here, which appears to be up 10% year over year. However, middle and upper homes are still falling. So the aggregate effect of that doesn't seem to be that stimulative. US inflation is on track to undercut the Fed's June predictions. So if you expand, or if you forecast CPI based on different month over month growth rates, currently we're on track to be around the 2.5 or perhaps slightly above level. Okay, signs of inflation in the coffee market. Here's the price of coffee in US dollars per pound. Has risen very strongly since the back end of last year. It was about 150. It's now up to $260. So perhaps a cup of tea at the moment.
Well, we know that food prices actually fell quite sharply in August. But climate change is causing havoc with individual commodities, increasing the volatility of soft commodity prices, I'd say.
So inflation is falling in the US. It does remain a bit above target, and the key determinants of inflation remain too high to be compatible with the 2% target, according to this analysis. Though I think a lot of the stuff that we covered earlier in the presentation suggests, we are pretty clearly heading towards 2.5%. It might be a touch above, but yeah, and different forecasts here. But I think most of the data we've looked at does suggest that inflation is pretty clearly dissipating.
That's true, but wage inflation is still too high. Now, in the US, they've had strong productivity growth. That means that they can afford high wage growth. But in the EU and UK, we have persistently high wage growth and very poor productivity. So, particularly in the UK, wage growth needs to come down much further in order for the 2% target to be sustainable.
So in summary, inflation is coming down quickly, but that's primarily due to goods deflation. Wage growth remains a bit too high to be compatible with 2% inflation target, particularly in UK and continental Europe. So interest rates may need to remain restrictive until wage growth moderates further, but that is you need to read that carefully. You can be restrictive, but still cut interest rates. It's just a question of how far you cut them.
Yeah. Okay, thanks, Stuart. On to recession watch. So if you back out recession probabilities from different asset classes, you get very different results. So bonds and base metals are saying actually there's an elevated chance of recession. Equities and high yield are saying there ain't. So lots of uncertainty. So there's a difference between how the labor market is behaving and how indicators of people's perception of the business cycle and the economy are behaving. And people are feeling more positive about the economy, but they're not hiring. So at some stage, that you'd expect that gap to close, because if people stop hiring and keep laying people off, and we've shown that the continuing claims are rising, then the economy will slow and go into recession. And this is the labour surprise index, very negative. So bottom line, a soft landing looks likely in the US, but it's not guaranteed. And onto other charts, Stuart.
China's electricity demand is rising inexorably. The red line here is going through the roof, while the US gently rising. Europe is pretty flat. So we do have an insatiable demand for energy as a species and as our economy is structured, and that requires the use of fossil fuels for a long time yet.
Yeah, we had a debate, I think, on the Discord about somebody was saying that they expected oil and coal prices to collapse because the rapid rise in renewables meant that demand for fossil fuels would collapse. And when you look at this chart, I just don't think that's true. I think
No, we need energy of all sorts. They're all growing.
yes, precisely.
So despite massive investment in renewables, China still generates 70% of its electricity from non-renewable sources, the vast majority of which is fossil fuels. And, you know, we need to be conscious too of India as being the next China. And of course, it's going to use a lot of its indigenous coal. It's just the immediate obvious choice.
Yeah, 80% of India's electricity generation is non-renewable, almost entirely coal.
Yeah. The top 10 coal-consuming countries in the EU, Germany. Goodness, I mean, I think a lot of the green movement came out of the anti-nuclear movement in the 70s and 80s, and they're so stuck on being anti-nuclear that they're closing the nuclear plants, which means they need to rely on their coal plants.
I
My
know.
understanding is the coal they use is a particularly dirty version of coal. So it really is, you know, you might not want nuclear, but it may be the least worst choice.
Yeah.
China is dominating in the EV market. I think we know this, don't we? We can look at the number of EVs on the road, more in China than the sum of the US and Europe put together. And then they're also becoming much, much cheaper. So you could tell Donald Trump that by importing a Chinese EV, you're benefiting from Chinese subsidies. They are supporting you.
Yeah.
But I don't think he'll look at it that way around.
Well, the thing is, I have problems with this in that the rhetoric is that China is dumping electric vehicles. The reality is the Chinese EV market is super competitive, and so they're producing better EV models, and their cycle of launching new models is much faster. Of course, they're getting better, and of course, they're more competitive. And when Germany exported loads of cars all around the world and dominated the internal combustion engine market, nobody accused the Germans of dumping. Now they're accusing China of dumping. It's not just because of subsidies.
No, no, they're good cars that solve a purpose. Then you don't have to buy a Tesla. You could buy something much more modest. Right, housing is expensive. Home prices compared to median household income, that ratio is hitting a high, even higher than prior to the GFC. That's a scary chart.
Yeah. On to good news. And this is the humble British bee. Now, I didn't know this. My wife is a beekeeper, by the way. But 250 of the 270 British bee species are solitary and don't live in hives. And Brighton and Hove Council have mandated that all new buildings in the city incorporate these bee bricks, which are normal bricks with a series of small cavities. Here you go. So our bees can nest in them. I doubt very much the survival of the species is going to depend on a few aerated bricks, but, every little helps. And on to equities, Stuart.
Well, as we mentioned at the top of the show, a good week for equities. The all-world index up a bit under 3%. And within that, some pretty big chunky moves in the US in particular. Russell 2000 and Nasdaq up over 4%. So here is the World Equity Index, almost back to its high after having come off sharply at the beginning of August. The FTSE All-Share, the UK hasn't really taken part in that. A lukewarm week, up by 0.8%, but basically flat since April. Euro Stoxx 600, you'll hate this, Keith, up 1%. You don't believe that European stocks deserve to go anywhere?
Yeah, I don't.
But it's pharmaceuticals, fashion, luxury products. It's not always just a reflection of the weak European consumer. S&P 500, however, here we go again, up 3% on the week, 18% year to date. This is capital return. Any dividends in this?
No dividends. This is just the headline index.
Nasdaq up 4% on the week, 17% for the year, though the chart seems to look a bit less positive than the S&P 500. I think that's sort of what Simon was saying in his technical analysis.
Yes.
Russell 2000, that's a pretty sharp jump, isn't it? 4% on the week. That looks very, very strong.
Yep. But again, when we look at small business earnings in the US, falling.
True.
So, up 8% year to date, but that doesn't seem to be matched by the fundamentals for US small companies.
Topics has been pretty weak since it bounced back from its very sharp fall in early August, but down 1% on the week and up only 8% year to date after a very strong first half of the year. The dollar index continuing to be very weak. It's fallen from the beginning of July, where it was about 106, now down to a bit over 100. So that's a pretty chunky fall for a currency.
Yes. So prospect of US interest rate cuts is causing a weaker dollar. That's good for emerging markets.
Yeah. VIX has settled down a bit after the early August spike, is now at 17.1, off 14% for the week. Obviously, it very much depends which point to which point you're measuring. It's step change up from the levels last year. Bonds yield more than equities. So what measure have we got here? Risk-adjusted real yields. So they favor US Treasuries over equities. So if you look at the earnings yield on the MSCI, is that world or US? Well, I suppose the US is 70% of the world, so it doesn't make too much difference.
It's US equities is the red line.
Okay, good. So the red line, yes, the real adjusted yield appears to be about -1% on GavKel's methodology compared to short-dated treasuries, which are more like 2.5%. So for the nervous amongst you, including myself, to favour bonds over equities. Oh no, this is a chart to warm the cockles of my heart. Tech valuations still look insane. So this measure from top-down charts is looking at an absolute and relative measure of the tech sector, and looking at a Z-score, looking at price to earnings, price to book, price to dividends, enterprise value to EBITDA, price to free cash flow. So lots of different valuation measures, and valuation of tech is very high compared to its own history. Not quite as high as the 98, 99 bubble, but not far off. So this plays to my prejudice of, yeah, tech is wonderful, but it's overpriced.
Absolutely. Where's that earnings growth going to come from? I mean, currently, historically, over the last 10 years, they have grown very quickly by, in the case of Google, etc., being essentially monopolies. And going forwards, you think that the regulatory environment appears to have changed, and there's a limit to the number of smaller companies they can keep on hoovering up to become more of a monopoly.
On an EV to sales basis, valuations are in fact higher than .com. I mean, I think the previous chart is probably more useful given that they use a different range of evaluation measures. But yeah, if you're buying tech at these levels, you've really got to hope for another following wind. Private investors are holding record amounts of their wealth in equities, have cut their allocations to cash. So this, I think, is a version of the chart that we've come up with a few times, suggesting that when equities are a very high share of people's assets, that's a time to sell, and it has reached the highest level, well, on this chart since 2010. Earnings forecasts are rising everywhere in both developed markets and in emerging markets. And given how lowly valued emerging markets are, that's quite an encouraging sign.
Yeah.
Equities are very expensive relative to bonds. And now this, I think, has got to be very, well, this is a US measure. I mean, I couldn't agree more. The valuation is so high of equities that risk-adjusted basis, it seems to me you've got to edge the other way. I mean, the edging that I've done is to hold equities, but hold very strong tilt towards the non-US equity markets, which has hurt me, but it's the only way I can sleep at night.
Yeah, I agree.
Within US equities, mid-cap appears to be the least highly valued at 15 times, which is actually quite a bit less than even the small cap. It's, oh, goodness, small cap is rated at 28 times.
Yeah, because their profitability is so low.
Whereas mid cap, I guess, at 15 times, you presumably got quite a few banks in there in the mid cap area. The reverse repo facility has been almost drained. So this was a process that pumped money into the financial system. And if it doesn't do so any longer, then if you believe that liquidity is what drives markets in the short and medium term, this, I guess, is a slightly worrying sign.
Yeah. Okay, thank you, Stuart. On to commodities. And it was a very good week for commodities everywhere. So oil bounced. EU natural gas prices fell actually quite sharply, which is good news for EU and UK consumers. US natural gas prices rose. Industrial metals had a generally strong week, particularly aluminium, copper, and tin, and precious metals were all strong, helped by a weakening US dollar. So they're all priced in dollars. So if we look at energy first, you'll see that the oil bounced back from its recent sell-off and lows. European natural gas futures came down and are now only up a bit on the year. US natural gas futures recovered strongly. Coal faded, uranium did pretty much nothing. So this is Brent. After the really strong sell-off over the past month, it had a bit of a bounce. Now, I prepared a whole section on the oil market that I will spin off as a separate podcast and aim to get out tomorrow. This is WTI, also bouncing. Numbers specific to the oil market. Well, that bounce occurred despite a strong inventory build in the US, up 9.2 million barrels on the week. So the US oversupplied. That does, however, follow a few weeks of drawdowns. US crude production remained constant at 13.3 million barrels a day, but that is down from the peak from the year. The Baker Hughes rig count rose by 5. Now, one thing that I will cover in my discussion of oil is that in the US, the Matterhorn pipeline is due to open in the coming weeks, and that will increase gas transport capacity from the Permian to Houston. Now, over the last few months, Permian oil producers have not been able to get rid of their gas because of a lack of pipeline capacity. And instead of making money on their byproduct gas, they've actually had to pay people to take it away. And so when the Matterhorn gas pipeline opens, that will get rid of the bottleneck. Permian oil producers will then be able to sell the byproduct gas once again at a profit, which will increase the economics of drilling in the Permian. And in an oil market that already looks oversupplied, that will encourage Permian producers to increase drilling. The oil market looks structurally weak to me. Hedge funds are giving up on oil. This is positioning in futures. And good news in the EU, natural gas prices coming back down. Same in the UK. In the US, natural gas prices rising again as we go into the winter period. Coal looking weak. On to industrial metals, Stuart.
So very big rise for aluminium this week. That's a standout number, and zinc too. So yeah, that's quite surprising given what we're saying in general about world economic demand outlook. But I suppose there's some element of bounce going on there. Well, this is the aluminium chart. That's a very strong picture, isn't it? Goodness.
It is.
7.6% on the week.
Now, the commentary was not very informative, frankly, just talking about dollar weakness, but the dollar only fell a little bit. It does not explain this.
Copper showing a similar bounce, but not of quite the same magnitude. Iron ore, that's a pretty ugly picture, isn't it? Taking a real step change down at the beginning of September. It's up, well, it's basically flat on the week, but off 35% for the year.
Yeah, I take this as being a direct reflection of Chinese economic weakness.
Neodymium has come off, took a step change down after having had a bit of a rally over the past few weeks. Nickel showing a little bit of sign of life, perhaps some sort of double bottom there, if we believed in double tops for our other assets.
Yeah,
3% on the week.
I remind you that Indonesia is going to be producing a wall of nickel over the next few years. I just can't see how nickel can show any structural strength.
Tin bouncing as well. Zinc, very much like the aluminium picture. That's a big step up, 9% on the week. Moving to precious metals. Well, gold had a good week, up 3%. Silver had an outstanding week, up 8%. So I guess some of this is dollar weakness, but perhaps it's more people looking at the OBR's forecast for the UK outlook and wanting a real currency. Palladium, by the way, also up very strongly, up 14% on the week.
Yeah, I mean, when you get gold at these prices, though, per ounce, the price of a gold wedding ring is like getting really very high. I mean, how high do you think gold can go in absolute terms?
Well, I don't know. It's not a market up. We need Richard on this. I mean, I read commentary that demand in traditional places like India, where, for instance, for a wedding you buy gold for people, has fallen off quite strongly. But financial buyers appear to be still very motivated.
Yeah.
So looking at it in the chart form, that looks a very encouraging chart, doesn't it? Bottom left, top right.
Yep, absolutely.
Silver a bit more volatile than that, but that's still a pretty positive picture, up 8% on the week. Platinum joining in the party, up 5% for the week, but rather a different picture longer term. It's basically sort of flat really for the year. Palladium also, and perhaps there's some commodity ETFs and there's some crossover effect of people buying a more general commodity exposure spilling over, but palladium up 14% on the week.
Yeah, amazing. It does have these, spikes up, which rapidly unwind. An illiquid market, I'd say.
Yeah.
Okay, Stuart, thank you for that. On to rates. So this is UK yield curve, and it has moved down over the past year. You'll still see this huge rise between the year and the 30-year. I mean, that is a big premium for taking duration. In the US, there's a similar effect, but nowhere near as pronounced. You'll notice in the US, you get the 30-year is below the 1 year. In the UK, it ain't. It's above. So this is the UK 2-year. It's started to fall again, which is good news. The 10-year is making a decisive break lower. That's great news. In order to balance the books, the UK needs lower interest rates, and actually displaying some fiscal responsibility will help that process. So the UK could well find that if it shows some fiscal responsibility now, its medium-term fiscal balance actually improves. And this is the 30-year. That little tick up this morning is just wrong. And that is starting to show a nice downward trend. To put things in perspective, this is the 25-year chart of the UK 30-year. That little trend down is that. You'll see that over the decade following the GFC, UK 30-year rates trended down to below 1%. Now, I'm not expecting that to happen, but could it get back to 33%? I think it absolutely could. Let's see what happens. This is the US 10-year, drifting down again. Good news. German also down. So moderating inflation is leading to expectations of interest rate cuts and falling bond yields. Concluding comments. Well, inflation is coming down everywhere, but the disinflation over the past year has been helped by goods deflation that looks unsustainable. Wage growth everywhere remains elevated, particularly in the EU and UK, and too high to be compatible with the 2% target. So wage growth has to come down and interest rates need to stay higher until we get wage growth down. The Chinese economy appears structurally weak, and all the data we've seen shows that it's weakening further. The Fed meets tomorrow. Will they cut by 25 or 50 basis points? Stuart, how have you been getting on?
Sat on my hands, no actual activity, but I'm beginning to think about copying some of your ideas of buying yield. I did get burned in some of my real estate investment trusts as rates went up. But conversely, therefore, I should benefit as rates come back down. And there have been a couple of REITs that I'm doing a bit more research on that I think might be protected even if we come into a recession. Their revenues hopefully will be supported and their asset values boosted by lower inflation, lower rates. So I haven't done anything yet, but doing a bit of research in that area.
Yeah, next week I will have a look at another one of the investment trusts. We covered the renewable infrastructure group last week. I'll look at another high yielding trust next week. I had a conversation with somebody on YouTube who was pointing out the performance of the battery investment trusts has been very poor. And I noticed that this morning, National Grid were talking about how their algorithm and their network meant that they hadn't been utilizing batteries even when the batteries were the cheapest form of energy. Instead, they'd been keeping coal-fired power stations back and gas-fired power stations on. So that's not good, but they are proposing to fix that. But fundamentally, I'm skeptical about battery because high upfront costs and then very intermittent revenues. I'm not sure that is a great business model.
If you're looking at some high yield things, I would also have a look at some of the infrastructure trusts. I think they're much safer and they've had growing dividends on top of a decent yield.
Okay, my week, well, bit of a better week, but still terrible. Obviously, I have taken a lot of duration risk, and so far this year, every other market in the world is up, bonds are down. So I remain not looking very clever, frankly. But finally, bonds appear to be moving. Inflation absolutely is coming down. Inflation has actually come down faster than I thought it would, but bonds have not reacted. Now, I expect them to, and I expect real yields to come back down because currently, when you look at UK inflation and the UK 30-year yielding 4.5% or 4.4%, what that means is if the UK returns inflation to its 2% target credibly, then the UK 30 yields 2.4% real. And I just think that's way too high, frankly. If you're looking at, for example, a wind farm project and your base interest rate is indexed to UK government gilts at real plus 2.5%, then I question whether it's economic. And stepping back, this is the long-term price chart of T68, the 2068 gilt. Obviously, it's been shit, and I have got absolutely killed because I didn't think you could get anywhere near this low, and I was wrong. But, you know, medium term, will it get back to 100? I think it probably will, frankly. So, you know, that bails me out, he says. But right now, I'm going to be looking to buy some high yield investment trusts, such as the infrastructure group. Its price has been sadly rising, and my limit orders have not been filled. But it's been a good few weeks for the stock market, and you know, let's see. I don't like chasing the market. Now, quickly talking about my recent purchase of Petrometad, which is the oil explorer with assets in Mongolia. It's not gone well because they've had permitting problems throughout the last period. The shares have been terrible. I thought the permitting problems were over, but no, they've found some more. So in order to get the well on production, they need a construction permit. They've had the land access permits granted. I thought that was the end of it, but no. So shares have fallen right back down to the lows. Very annoying. Watch this space. Okay, that's it. Thank you very much for watching. Please can you press like and subscribe to the channel. Reminder, the next one will be next Friday with Richard. In the meantime, thank you very much to Stuart Owen for filling in. And it's goodbye from Stuart Owen.
And goodbye from Keith Jordan.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.